How does a stock surge 29% in a single week, boast a strong buy rating from Wall Street, yet simultaneously have legendary short sellers betting massive amounts of capital that it's a dangerous trap?
I mean, it is the ultimate market paradox right now. It's literally tearing institutional trading desks apart.
Welcome to today's deep dive. We're looking squarely at MicroStrategy Incorporated, ticker symbol MSTR. And as of today, April 2026, the stock is trading at $170.81.
Which is just a crazy level if you consider where it started.
Right. We're witnessing this wild, basically unprecedented transformation. I mean, it's a legacy software company that's essentially morphed into a high-leverage Bitcoin proxy.
Exactly.
And real quick, if you're watching this while, sweating over your own MSTR position, you need to hit that like button right now, subscribe to our YouTube channel, and definitely jump into the comments.
Seriously, leaving feedback is absolutely compulsory today. We want to know where you stand on this wild debate. Yeah, because the tribalism around this specific ticker is, well, it's unlike anything else in the market. You've got true believers treating it as this digital fortress, right?
Yeah.
And then traditional value investors are looking at it like it's a ticking time bomb.
Okay, let's unpack this. Our mission today is to dissect MicroStrategy's financials, pull apart these incredibly conflicting technical charts, and follow the insider order flow.
Which is fascinating right now, by the way.
Oh, absolutely. We need to figure out what's really driving this incredible 29% weekly momentum. Because, well, on the surface, the numbers just don't seem to match the reality of the price action.
What's so fascinating here is the sheer scale of the leverage involved. Like, MicroStrategy isn't just a company anymore.
No, not at all.
It acts as a flawless mirror for extreme bullish optimism in the crypto space, while simultaneously reflecting this severe bearish skepticism in traditional finance.
Right.
It's basically a localized battleground for macroeconomic philosophy.
Well said. And to really figure out if this stock is a hidden treasure or a massive value trap, we can't just look at the stock price. I mean, you have to look under the hood at the actual money moving in and out.
Absolutely.
So shifting focus to the fiscal year 2025 financials, because man, these figures look like they belong to two completely different companies. Let me lay out the core numbers for you.
Go for it.
So total revenue for fiscal year 2025 came in at $477.23 million.
Which is a modest 3% year-over-year increase.
Right. Solid, sustainable, boring software revenue. But then you drop down to the bottom line and hit the jaw dropper, a net income of negative $3.85 billion.
Oh, would it be?
And a trailing 12-month earnings per share of negative $15.23. Like, you're looking at a company with $500 million in revenue managing to post a nearly $4 billion loss.
I know. That net income figure sounds completely catastrophic until you start picking apart the accounting mechanics.
Right.
That massive multi-billion-dollar deficit is largely a paper loss. It's driven by a $17.4 billion unrealized loss on digital assets reported in the fourth quarter of 2025.
Because the fair value accounting rules for crypto assets, right?
Exactly. They are forced to mark the value of that massive Bitcoin treasury to the current market price at the end of the quarter.
Ah, I see.
So even if they haven't sold a single Satoshi, a localized dip in Bitcoin's price completely nukes their quarterly income statement.
Wow.
Yeah, totally obscuring the fact that their core software business is actually churning along fine.
So algorithmic screeners and institutional models that rely on top-line EPS?
They're constantly throwing red flags, yeah. Because the income statement is basically a hostage to Bitcoin's daily volatility.
That is wild.
But if you pivot over to the balance sheet, the true scale of their strategy really comes into focus. We're looking at a staggering imbalance, $61.64 billion in total assets, weighed against $10.60 billion in liabilities.
Okay.
And sitting there in cash and equivalents as of December 31st, 2025 is $2.3 billion.
Which, I mean, on paper, that sounds like a fantastic cash cushion. But you can't ignore the operational cash flow drag.
No, you can't.
Their operational cash flow is negative $67.24 million. So the core software business, despite growing, simply isn't generating the sheer volume of cash required to service the debt and sustain this super aggressive Bitcoin acquisition strategy.
Right.
They're literally burning cash to keep the lights on while stuffing the vault with digital gold.
And that operational burn rate is exactly why they recently had to tap the markets again. They raised $2.54 billion.
Wow.
And they aren't doing that through organic software sales. They're heavily utilizing at-the-market offerings, printing and selling more stock and issuing preferred stock, specifically the STRC shares.
So they're diluting the equity base to fund the treasury.
Precisely.
Taking that a step further, it's like someone who makes a decent, steady salary, but takes out multiple massive mortgages just to buy gold bars.
That's actually a great analogy.
The strategy works brilliantly as long as the gold appreciates faster than their cost of capital. But it introduces this incredible structural fragility. So at what point does this debt funding strategy crack under its own weight?
That is the multi-billion-dollar tension at the heart of this company. But what's really compelling is that right now, the broader market seems to be completely ignoring that negative cash flow and the structural fragility.
Yeah, they really are.
The market is just trading on raw momentum.
Which means we need to look at the daily charts, because the price action is telling a totally different story than the income statement. We've got this massive 29% surge, pushing us up near $171. But the technicals are a complete mess of conflicting signals.
Oh, it's a textbook case of conflicting trend timeframes. On the micro level, we're in a really powerful short-term bullish recovery phase.
Right.
Buyers have stepped in aggressively, absorbing any localized sell pressure. But if you zoom out to the macro view, the long-term trend remains decidedly bearish because the stock is still trading below its 200-day moving average.
And for institutions, that 200-day moving average is the psychological dividing line between a structural bull and bear market, right?
Exactly. If you're managing a risk-averse portfolio, you aren't touching a stock below that line, regardless of a weekly 29% pop.
So for you listening right now, let's map out the immediate battle lines. On the upside, there's incredibly stiff resistance at $173, which aligns with the recent local high.
Yeah, that's a key level.
If the volume pushes it through that ceiling, the immediate breakout target sits at $185. But if it rejects and rolls over, support sits firmly at $151.
Which was a major prior rejection zone.
Right. And if that snaps, there's a massive air pocket all the way down to major volume-based support at $123.
And the volatility between those bands is where day traders are making or losing absolute fortunes right now.
So what does this all mean? Because if I pull up the standard momentum indicators, we have a glaring technical contradiction.
Oh yeah, it's a mess.
The RSI is sitting right around 72. That's pushing deep into overbought territory, signaling the stock has gone up way too far too fast and is begging for a short-term pullback or consolidation.
Yep.
But then you glance down at the MACD and it's sitting at 6.88, printing a massive accelerating buy signal. How should a trader interpret a chart screaming buy and overbought at the exact same time?
It's maddening for pure technical analysts. I mean, it really is. But that divergence exists because the price action we're seeing isn't organic.
What do you mean?
Well, the indicators are breaking down because they're designed to measure natural human market sentiment. And what we're looking at right now is highly mechanical. The charts are messy because of who is trading and how they are trading. We're looking at order flow dominated by market manipulation through hedging.
You mentioned this mechanical buying, which immediately makes me think of the plumbing of the market, the order flow and the options chain. Where is the big money actually moving?
So the tape shows heavy, aggressive buying in the $160 to $166 range over the last few sessions. That's the engine room for this current momentum.
Okay, good.
We're also seeing massive institutional demand layered near the $100 level for that STRC preferred stock. Institutions are basically building a deep liquidity moat down there.
But the day-to-day, minute-to-minute price action feels wildly erratic. It doesn't feel like institutions quietly accumulating shares. It feels like forced buying.
That's because it is forced. Market makers are actively gamma hedging near critical options strike prices, and it's heavily distorting the stock's natural trajectory.
Let's pull the thread on that gamma squeeze mechanism, because it's vital for understanding this volatility. If retail traders and speculative hedge funds are piling into short-dated call options,
basically placing massive leveraged bets that MSTR is going to rocket higher.
Right. Then the market makers who sell them those contracts are suddenly exposed to infinite upside risk.
Precisely. To neutralize that risk and stay delta neutral, those market makers are mathematically forced by their own risk algorithms to buy the underlying MSTR stock as the price goes up.
Wow. So the higher the stock climbs, the more these massive institutions are literally forced to buy it.
Yes.
Which creates this self-fulfilling feedback loop of aggressive buying pressure that has absolutely zero to do with the company's fundamental valuation. It's just a mechanical trap.
Exactly.
And the terrifying part for retail traders is that this mechanism works in reverse on the way down, creating algorithmic avalanches of selling pressure.
It completely obscures true market sentiment. You honestly can't tell if a rally is based on genuine belief in the company's future or just an options desk covering its exposure.
Which makes following the so-called smart money incredibly difficult. But we do have one clear signal from the smart money inside the building.
Oh, you mean the insiders?
Yeah, the insider selling at MicroStrategy right now is throwing up some massive red flags.
The Form 4 filings have been relentless lately.
We're looking at CEO Feng Lei and director Jared Michael Patton heavily dumping shares throughout March and April of 2026.
Yeah.
In just the last 90 days, those two alone account for over $8.7 million in net selling. Now, I know the standard defense is that these sales are often tied to predetermined 10b5-1 trading plans or derivative exercises to cover tax obligations.
Sure, that's the standard corporate shield, yes.
Yeah.
But the optics are brutal. I mean, you have the CEO taking millions of dollars in liquidity off the table, while retail traders are leveraging their portfolios to chase a 29% momentum surge.
Exactly.
It naturally forces you to question what the insiders see that the retail market is ignoring.
And it isn't just the executives heading for the exits. Short interest reached historical record highs in mid-2025, and it hasn't really tapered off. We're seeing legendary, sophisticated short sellers like Jim Chanos actively attacking the stock.
Yeah, the big guns.
Why would institutional titans step in front of a volatile freight train like MicroStrategy?
Well, if we connect this to the bigger picture, it's crucial to understand what these institutional bears are actually shorting. Chanos and his peers aren't necessarily betting against Bitcoin itself.
Okay, then what are they betting against?
They are attacking the massive premium MicroStrategy trades at relative to its net asset value, or NAV.
Which is just the total market value of the 815,000 Bitcoin they hold, divided by the number of outstanding shares.
Right. And MicroStrategy routinely trades at a massive multiplier higher than the actual value of the crypto sitting in its treasury. The short sellers are betting that this premium is mathematically irrational and will eventually collapse.
So they'll short MicroStrategy stock and simultaneously go long on Bitcoin via the futures market or an ETF, purely playing the arbitrage on that spread.
Exactly.
Let me put that NAV premium into perspective with an analogy. Paying the current premium for MSTR is like paying a $300 cover charge to get into an exclusive nightclub, just so you can buy a bottle of water that's worth $100 inside.
That is exactly what it's like.
A few years ago, that cover charge made sense because MicroStrategy was the only club in town for institutional investors who wanted Bitcoin exposure but couldn't legally hold the raw asset. But now, we have dozens of spot Bitcoin ETFs. The club has a free backdoor. Why on earth is anyone still paying the $300 cover charge?
That's the exact thesis driving the short sellers. The ETF approvals should have mathematically destroyed the MicroStrategy premium. But it hasn't. It's persisted.
Meanwhile, retail traders, completely mesmerized by the flashing green lights of a 29% weekly surge, jump in blind and end up providing the exit liquidity for both the insider selling and the institutional shorting.
Yep, they get trapped.
It's an absolute battlefield.
It really is a highly complex derivatives playground masquerading as a mid-cap tech stock.
Which makes this next data point completely absurd. Despite the structural cash burn, despite the insiders dumping shares, and despite legendary short sellers publicly attacking the NAV premium,
Wall Street is painting a totally euphoric picture.
yes, the divergence between the analyst ratings and the on-chain reality is staggering. Let's look at the signals. Is this stock fundamentally undervalued, or are we looking at the mother of all value traps?
The consensus from the analyst desks is borderline hysterical euphoria.
Check out these numbers. The overwhelming Wall Street consensus right now, 14 buys, one single hold rating, and absolutely zero sells.
Wow.
Not a single covered analyst is telling their clients to sell this stock. The average price target sits at $371.07. That is more than double the current price.
Incredible.
The high-end estimate is a staggering $705 per share. Even the conservative short-term forecasts are calling for it to hit $211.19 by April 24. They are aggressively, wildly optimistic.
They are, and they're justifying those targets by viewing MSTR not as a company, but as a unique leveraged instrument that doesn't charge a management fee, unlike the ETFs.
Right.
But this setup feeds perfectly into the value trap argument.
Break down the trap for me, because if 14 analysts are saying buy, what are they missing?
The trap lies in that very premium we discussed. Let's say you buy MSTR today because you're incredibly bullish on Bitcoin reaching $150,000.
Okay.
If Bitcoin hits your target, but the market simultaneously decides that MicroStrategy's corporate premium is no longer justified and collapses it down to a 1-to-1 NAV ratio, MSTR stock will plummet.
Ouch.
Yeah. You could be 100% right about the underlying asset's macroeconomic trajectory and still lose half your portfolio value on the stock because the premium evaporated.
So are Wall Street analysts ignoring the NAV premium, or do they just believe the leverage strategy justifies it?
They believe in the flywheel. Wall Street's optimism is heavily reliant on one specific underlying asset. They assume MicroStrategy can continue to borrow cheap fiat currency to buy an exponentially appreciating digital asset infinitely.
Which naturally leads us to the ultimate bull and bear scenarios. Let's lay out the extremes. What does the absolute best case recovery scenario look like versus the worst case continuation lower?
Well, the foundation of the bull case is gravity. MicroStrategy holds a staggering 815,061 Bitcoin, is the largest institutional treasury in the world.
A massive hoard.
Because of its debt-funded strategy borrowing money at fixed, low rates to acquire a hard-capped asset, it historically outperforms Bitcoin itself during major bull runs. It acts like a levered ETF, but without the daily decay you usually suffer in those products.
Plus, we can't completely ignore the legacy software business. Their actual software subscription revenue grew an impressive 62.1% year over year in the fourth quarter of 2025.
That's true.
So there is a real transitioning cloud business attached to this massive crypto vault. But what about the bear case?
The downside risks are genuinely terrifying. First, you have to look at the stock's high beta, which currently sits at 3.57.
Meaning it's 3.5 times more volatile than the S&P 500.
Exactly. It's a volatility multiplier. If Bitcoin stalls out, or if geopolitical risks spike, MicroStrategy will fall significantly faster and harder than the rest of the market. And second, we have to talk about the severe dilution risk.
From the constant at-the-market share offerings.
Yes. The only way the company can maintain its aggressive Bitcoin purchasing schedule is by constantly issuing and selling new shares to the public.
Right.
Every single time they print a new share, they dilute the ownership percentage of everyone currently holding the stock.
Thinking about the retail trader out there listening to this, with a beta of 3.57, isn't this basically a roller coaster without a seatbelt for the average investor?
It really is. It is the furthest thing from a buy-and-forget index fund. Trading MSTR demands hyperactive risk management and a deep understanding of options flow.
So, as we wrap up, we need to be incredibly clear. We are providing a natural human debate here. This is absolutely not financial advice.
No, definitely not. Do your own research.
But looking at the outlook, how do you synthesize the short-term perspective versus the long-term?
In the short term, the stock is heavily reliant on immediate technical breakouts and momentum. It's trading purely on emotion and gamma hedging.
And long-term?
In the medium to long term, projections of hitting $406 by 2030 are entirely dependent on Bitcoin reaching new cycle highs.
Here's where it gets really interesting. We have an impending danger zone on the calendar. The next earnings report is just around the corner on May 5, 2026.
And the street's projections are grim. Analysts are projecting an ETS loss of $2.04.
Which leaves you with a critical final thought to chew on. If the premium to NAV is sitting at a historical high right now, and the May 5th earnings report prints another massive loss, will that be the pin that finally pops the premium bubble?
Handing the short sellers a massive victory.
Exactly. Or will it just be another aggressive buying opportunity for the true believers? You have to look at those technical charts, look at the insider sale, and ask yourself, in a market flooded with mechanical gamma hedging, who is really in control of the order flow?